Hello students and welcome to the lecture. So students, as you can see here, that basically in this lecture, we are going to talk about the financial organizations and regulatory framework. Okay, this is going to be a topic, the financial organizations and regulatory framework. In this lecture, we will talk about this in a explanation manner. Okay, like you can say, basically in this lecture, we are going to talk about the NBFCs in India, difference between the banks and the NBFCs, requirements for registration with RBI, systematically important NBFCs, RBI regulate all financial companies. Then we will see that who regulates the above given NBFCs that we will cover here. Different types of categories of NBFCs that are registered with the Reserve Bank of India. The asset finance company, the investment company, the loan company, the infrastructure finance company, systematically important core investment company, infrastructure debt fund like non-banking financial company, non-banking financial company like microfinance institution, non-banking financial companies, factors, mortgage guarantee companies, MGC, non-operative financial holding company, NOFSC, owned fund and net owned fund relation to the NBFCs. Then we will see if there is any ceiling interest rate charged by the NBFCs to their borrowers, residuary non-banking company, and different forms other than the NBFCs. Then we will see the important regulations relating to the acceptance of deposits by NBFCs. Then we will see that what is the money circulation, Ponzi and multi-level marketing schemes. Then we will see the banking and the NBFC ombudsman. Then NBFC's Ombud Scheme 2006, NBFC ombudsman, and who can file a complaint about it. And at last we will have the discussion on the summary of all of these things. So now you can see by yourself that this is going to be an important lecture from the examination point of view. So it is advisable to all of you, kindly pay attention here. But before starting this lecture, we have a small disclaimer to be discussing. And the disclaimer is like, the images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, then please contact us at sathee@iitk.ac.in and we shall remove the images. Okay. Now, let's begin with the topic. So here we are going to talk about the NBFCs in India. Okay. So first we have to talk about like what is actually a non-banking financial company. NBFC. A non-banking financial company is a company registered under the Companies Act 1956, which is engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, securities that are issued by the government or local authority or other marketable securities, leasing, hire purchase, insurance businesses, and chit business. Okay, but does not include any institution whose principal business is that of agricultural activity and industrial activity, purchase or sale of any goods other than the securities, or providing any services and sale, purchase, construction of a movable property. Note, a non-banking institution which is a company and has principal business of receiving deposits under any scheme or arrangement in one lump sum or in installments is also a non-banking financial company, residuary non-banking company. Okay, like a non-banking financial company could be anything by seeing this. The company which is involving in the business of loans and advances, involved in acquisition of shares, stocks, bonds, debentures, and securities that are issued by the government or any other local authority or marketable securities, engage in leasing, hire purchase, insurance business, and chit business. But it does not include any institution whose principal business is that of agriculture activity, industrial activity, purchase or sale of any goods other than securities, or providing any service and sale, purchase, construction of the immovable property. So these are some points that are notable. But remember, the non-banking institution is a company and has principal business of reposing deposit under any scheme or arrangement in one lump sum or in installment. It is also a non-banking financial company and all. Now let's move forward. Now we have to see that what is the actual difference between the banks and the NBFCs, the non-banking financial companies. NBFCs lend and make investments and hence their activities are akin to that of banks, but there are sub differences. First, the NBFC could not accept the demand deposits like the bank. Second, NBFCs do not form part of the payment and settlement system and could not issue checks drawn on itself. Like as the bank could have the access to the payment and settlement system, and also they have the facility of checks. NBFCs are not entitled to getting participated in any payment and settlement system, and also they could not issue checks also. Then the deposit insurance facility of Deposit Insurance and Credit Guarantee Corporation is only available to the bank and not available to the depositors of NBFC, like the person who have deposited the money with the NBFC under any scheme. He is not entitled to access the insurance facility granted by the Deposit Insurance and Credit Guarantee Corporation, like as it is available in banks. Now, what are the requirements for registration with Reserve Bank of India? A company incorporated under the Companies Act 1956 and desirous of commencing business of non-banking financial institution defined under Section 451A of the RBI Act 1934 should comply with the following things. First, should be a company registered under Section 3 of the Companies Act 1956. First thing. Then, should have a minimum net owned fund of rupees 200 lakhs, which means 2 crores. Then, only the company could be registered as an NBFC. First, must be registered under the Section 3. Sections are important. Okay. Kindly remember then the sections are important. Okay. Under Section 3 of Companies Act 1926 and must having a minimum net owned fund of rupees 2 crores. Okay. Under Section 451A of the RBI Act 1934, it must be a non-banking financial institution under the definition. Got it? Systematically important NBFCs. NBFCs whose asset size is of rupees 500 crores or more, as per the last audited balance sheet, considered as the systematically important NBFCs. Okay. The rationale for such classification is that the activities of such NBFCs will have a bearing on the financial stability of the overall economy. Now, RBI regulate all financial companies? No, it doesn't. RBI does not regulate all the financial companies. The housing financial companies, merchant banking companies, stock exchanges, and the companies engaged in business of stock broking, sub-broking, venture capital fund companies, nidhi companies, insurance companies, and chit fund companies. These all are NBFCs, but they have been accepted from the requirement of registration under the section 45 IA of the Reserve Bank of India Act 1984 and subject to the certain conditions only. Like these all companies are not the part of this. Now let's understand who regulates the above given NBFCs. Non-banking financial companies. Housing finance companies regulated by the National Housing Bank NHB. Merchant banker, venture capital fund company, stock exchanges, stock brokers, sub-brokers, they all are regulated by the Securities and Exchange Board of India, SEBI. Okay. Insurance companies regulated by the Insurance Regulatory and Development Authority, IRDAI. Chit fund companies regulated by the respective state governments. Nidhi companies are regulated by the Ministry of Corporate Affairs, Government of India. So when we look at them, we generally consider that all these are regulated by the Reserve Bank of India, which is not actually a real case. The Reserve Bank of India only, you can say, regulate the certain companies and the companies which are got registered under Section 45 IA of the Reserve Bank of India Act 1934. And also they are subjected to the certain conditions. Got it? And the other companies that we have seen which are not regulated by the Reserve Bank of India, these companies are generally regulated by their own areas, like merchant banker, venture capital fund, stock exchanges, stock brokers, sub-brokers, we have seen. These are regulated by the Securities and Exchange Board of India. Insurance companies, these are regulated by the Insurance Regulatory and Development Authorities. Chit fund companies, regulated by the respective state governments in which they are operating. And nidhi companies are always regulated by the Ministry of Corporate Affairs under the Government of India. Note, the mortgage guarantee companies, they have been notified as non-banking financial companies under Section 45 IF of the Reserve Bank of India Act 1934. The core investment companies with asset size of less than 100 crores and those with asset size of rupees 100 crores and above are exempted from the registration with the Reserve Bank of India. Okay. Now, what are the different type categories of NBFC registered with Reserve Bank of India? So NBFCs are categorized first in terms of the time of liabilities, like deposit and non-deposit accepting national banking financial companies, NBFCs. Second, non-deposit taking NBFCs by their size into the systematically important and other non-deposit holding companies like NBFC NDCI and NBFC ND. Third, by the kind of activity they conduct. So on the basis of this, we could define them and we could categorize them. First, on the basis of their liabilities like deposit and non-deposit, on the basis of systematically importance, and on the basis of the activities they are usually conduct. Now we have the assist financing companies, AFC in short. What are these? So an AFC is a company which is a financial institution on as its principal business the financing of physical assets supporting the productive economic activity, such as the automobiles, tractors, lathe machine, generator sets, earth moving and material handling equipments, moving on, own power and general purpose of industrial machines. The principal business for this purpose is defined as aggregate of financing and real fiscal assets supporting the economic activity and income arising therefrom is not less than 60% of its total assets and total income respectively. Okay. Then we have the investment company IC. The IC means any company which is a financial institution carrying on as its principal business the acquisition of securities. The loan company LC. LC means any company which is the financial institution carrying on as its principal business the providing of finance, whether by making loans or advances or otherwise for any activity other than its own but does not include any AFC or asset finance company. Okay. Then we have the infrastructure finance company IFC. IFC is a non-banking finance company. It deploys at least 75% of its total assets in the infrastructure loans, having a minimum net own funds of rupees 300 crores, has a minimum credit rating of A or equivalent, and a CRR of 15%. Okay. Now we have systematically important core investment companies. CIC and DCI. CIC and DCI is actually an NBFC which carrying on the business of acquisition of shares and securities satisfies the given conditions. First, holds not less than 90% of its total assets in the form of investment in equity shares, preference shares, debt or loans in group companies. Second, investments in the equity shares in group companies constitute not less than 60% of its total assets. Third, does not trade in its investment in shares, debt or loans in group companies except through block sale for the purpose of dilution or disinvestment. Then, does not carry on any other financial activity except the investment in bank deposits, money market instruments, government securities, loans to, and investments in debt issuance of group companies or guarantees issued on behalf of the group companies. Then, asset size is rupees 100 crores or above, and it accepts the public funds. Then it could be the systematically important core investment company, CIC, ND, and SI. Infrastructure debt fund. Non-banking financial company, IDF, NBFC. IDF NBFC is a company registered as NBFC to facilitate the flow of long-term debt into the infrastructure projects, to raise resources through the issue of rupee or dollar denominated bonds of minimum 5 years maturity. Only infrastructure finance companies can sponsor the IDF NBFCs. Okay. Now, non-banking financial company as the microfinancial institution, NBFC MFI. It is a non-deposit taking NBFC having not less than 85% of assets in the nature of qualifying assets which satisfy the following criteria. First, loan disbursed by an NBFC MFI to a borrower with a rural household annual income not exceeding the rupees 1 lakh or urban or semi-urban household income not exceeding rupees 1,60,000. Loan amount does not exceed rupees 50,000 in the first cycle and 1 lakh in the subsequent cycle. Total indebtedness of the borrower does not exceed rupees 1 lakh. Tenure of the loan not to be less than 24 months for the loan amount in excess of rupees 15,000 with prepayment without penalty. Loan to be extended without collateral. Aggregate amount of loans given for income generation is not less than 50% of the total loans given by the MFIs. Loan is repayable on weekly, fortnightly, or monthly installments at the choice of the borrower. Now, NBFC's factors. First, non-deposit taking NBFC engage in the principal business of factoring. Then the financial assets in the factoring business should constitute at least 50% of its total assets, and its income derived from the factoring business should not be less than 50% of its gross income. The mortgage guarantee companies, MGCs. MGCs are financial institutions for which at least 90% of the business turnover is mortgage guarantee business, or at least 90% of the gross income is from mortgage guarantee business, and net owned fund is rupees 100 crores. Then, NBFC non-operative financial holding company. It is a financial institution through which promoter or promoter groups will be permitted to set up a new bank. Wholly owned non-operative financial holding company, which will hold the bank as well as other financial services companies regulated by the Reserve Bank of India or other financial sectoral regulators. Owned fund and net owned fund in relation to the NBFCs. Owned fund means aggregate of the paid up equity capital, preference shares which are compulsory convertible into equity, free reserve, balance in share premium account, and capital reserve presenting the surplus arising out of the sale proceed of assets, including the reserves created by the revaluation of assets. Net owned fund, amount as arrived at above minus the amount of investment of such company in shares of its subsidiaries companies in the same group and all the NBFCs and book values of debentures, bonds, outstanding loans, and advances. Now let's look, is there any ceiling on interest rate charged by the NBFCs to their borrowers? RBI has dysregulated interest rate to be charged to the borrowers by financial institutions other than the NBFC microfinance institutions. Then, residuary non-banking company and different from the other NBFCs. The residuary non-banking company is a class of NBFC which is a company and has its principal business the receiving of deposits under any scheme or arrangement or in any other manner. These companies required to maintain the investments as per the directions of RBI. In addition to liquid assets, there is no ceiling or raising a deposit by RNBC. Every RNBC has to ensure that the amounts deposited with it are fully invested in approved investment. In order to secure the interests of depositors, such companies are required to invest 100% of their deposit liability into the highly liquid and secure instruments, namely the central state government securities, fixed deposit with scheduled commercial banks, certificate of deposits of SCBs, and units of mutual fund, etc. The minimum interest rate an RNBC should pay on the deposit should be 5% to be compounded annually on the amount deposited in lump sum or at monthly or no longer intervals. 3.5% on the amount deposited under the daily deposit scheme. An RNBC could accept deposits for a minimum period of 12 months and maximum period of 84 months from the date of receipt such deposits. They could not accept deposits payable on demand. Thereafter, the NBFCs are allowed to accept renew public deposits for a minimum period of 12 months and maximum period of 16 months. They could not accept deposit repayable on demand. NBFCs could not offer the interest rate higher than the ceiling rate prescribed by the Reserve Bank of India from time to time. The present ceiling is 12.5% per annum. The interest rate may be paid or compounded at rest not shorter than monthly rates. The NBFC could not offer gifts, incentive, or any other additional benefit to the depositor, should have minimum investment credit rating. Deposit with NBFCs are not insured, and repayment of deposits by NBFCs not guaranteed by the Reserve Bank of India. There is important news. SEBI is the regulator of CIS, Collective Investment Scheme. Chit funds governed by the Chit Funds Act 1982, which is a central act administered by the state governments. Thereafter, what are the money circulation Ponzi multi-level marketing schemes? Money circulation multi-level chain marketing or Ponzi schemes are schemes promising easy or quick money upon enrollment of members. Income under multi-level marketing or pyramid structured schemes do not come from the sale of products. They offer as much from enrolling more and more members from which hefty subscription fees are taken. Thereafter, Banking and NBFC Ombudsman Scheme 2006. Banking Ombudsman Scheme is an expeditious and inexpensive forum for bank customers for resolution of complaints relating to the certain services rendered by the banks. introduced under the Section 35A of the Banking Regulation Act 1959 by the Reserve Bank of India and got effect from 1995. Presently, the Banking Ombudsman Scheme 2006, as amended up to July 1, 2017, is in operation. Who is a Banking Ombudsman? Senior official appointed by the Reserve Bank of India to redress customer complaints against deficiency in certain banking services covered under the grounds of complaint specified under Clause 8 of the Banking Ombudsman Scheme 2006, amended up to 1 July 2017. As on date, 20 bank ombudsmen have been appointed with their offices located mostly in state capital. Banks covered under the Banking Ombudsman Scheme 2006, all scheduled commercial banks, regional rural banks, and scheduled primary cooperative banks are covered under the scheme. Then, when can one file a complaint against the bank? One can file a complaint before the banking ombudsman if the reply is not received from the bank within the period of 1 month after the bank concerned has received one complaint, or the bank rejects the complaint, or if the complaint is not satisfied with the reply with the bank. Note: ombudsman does not charge any fee for filing and resolving the customer complaints. It is absolutely free. Okay. Then, limit on the amount of compensation. The amount, if any, to be paid by the bank to the complainant by a way of compensation for any loss suffered by the complainant is limited to the amount arising directly out of the act or omission of bank, or rupees 20 lakhs, 2 million, which is low. Note: Banking Ombudsman may award compensation not exceeding rupees 1 lakh, rupees 100,000 to the complainant for mental agony or harassment. Is there any further resource applicable if one rejects the Banking Ombudsman decision? Any person against a decision of Banking Ombudsman could approach the Appellate Authority. Appellate Authority is vested with the Deputy Governor of Reserve Bank of India. No one can file the appeal against the award or decision of the Banking Ombudsman rejecting the complaint within 30 days of the date of receipt of the complaint. Thereafter, what is the scheme for the NBFCs? RBI introduced Ombudsman scheme for the customers of NBFCs. It is expeditious and cost-free apex level mechanism for resolution of the complaints of customers on NBFCs related to the certain services rendered by the NBFCs. Being introduced under Section 45L of RBI Act 1994 with effect from Survey 2018. Thereafter, what is the NBFC Ombudsman? NBFC Ombudsman is a senior official appointed by the Reserve Bank of India to address the customer complaints against NBFCs for deficiency in certain services covered under the grounds of complaint specified under Clause 8 of the scheme. As on date, 4 NBFC ombudsmen have been appointed with their offices located at Chennai, Kolkata, New Delhi, and Mumbai. Which are the NBFCs covered in the scheme? NBFCs which are defined under Section 45IF of RBI Act 1994 and registered with the RBI under Section 45IA of RBI Act 1994 and authorized to accept deposits, have customer interference with asset size of 1 million rupees or above, as on the date of audited balance sheet of previous financial year, or of any such asset size as per the RBI may prescribe, covered under the scheme. The scheme initially covers NBFCs authorized to accept deposits and would be gradually extended to cover other identified NBFCs. One, file a complaint. For redressal of grievances, a complainant must first approach to the concerned NBFC. If NBFC does not reply within a period of 1 month after receipt of complaint, or NBFC rejects the complaint, or if complainant is not satisfied with the reply given by the NBFC, the complainant could file the complaint with NBFC Ombudsman under whose jurisdiction the branch registered office of NBFC falls. Note: the NBFC Ombudsman does not charge any fee for filing and resolving the customer complaint. What is the limit amount of compensation? The compensation amount, if any, which could be awarded by the NBFC Ombudsman for any loss suffered by the complainant is limited to the amount arising directly out of the act or omission of the NBFC, or rupees 1 million, which is lower. NBFC may award compensation not exceeding rupees 0.1 million to the complainant for causing mental agony and harassment. Is there any further resource available in one rejects the NBFC Ombudsman decision? Yes. The scheme provides the appellate mechanism for the complaint as well as for the NBFC. It is vested with the Deputy Governor in charge of the Department of RBI implementing the scheme. Note: no one can file against the award or decision of the NBFC Ombudsman rejecting the complaint within 30 days of the date of receipt of communication of award or rejection of the complaint. Here we have finished the topic. Now it's a part for summary. We have seen the NBFCs, their definition, key features, regulatory requirements, categorization of NBFCs, size, activities they perform. Then other important notes we have seen. We have seen the Banking Ombudsman scheme, Banking Ombudsman and coverage, filing complaints, compensation limit, further resource, ombudsman scheme for non-banking financial companies, coverage, and filing complaints. Then compensation limits, further resource. With this, we have finished this topic. It is requested to all of you kindly revise the facts and figures that all we have discussed in this lecture. Be ready for the next lecture. With this note, let's end this lecture and thank you.